Hello and welcome back again. We're going to talk about Robinhood, a very, very well known broker that is actually a recent IPO. You will see that they IPO'd back in July 28 and they reached the high of like 85 at some point. And right now they're sitting at almost $16, as you'll see here. Yet some recent news brought the company at about 25% higher than what it used to be. You will see it here in this module that yesterday they were like 25% higher. That is March 29. But we do want to quickly discover why that happened, so we can take a quick look at the stock news here for Robinhood, that is, and you will see that Robinhood extends trading hours from 7 a.m. to 8 p.m. and this is why it actually caused this massive increase. As you see, Robinhood soars because of that. Now we will take a look at the actual financials of the company, see whether it actually makes sense to buy it, because this is a 1 month chart here. But if you go back to 3 months or 6 months, you'll see this picture, or a year, or even like the whole thing. Like let's go 5 years, which is like the whole story of this company. It's a recent IPO again. It actually opened up, as you can see, at about 38, and then at some point it reached 85. And this is why I'm telling people that they should never really trade recent IPOs, because the price hasn't stabilized, and that's very, very important. And so if you had bought here, you have been massively annihilated here. And this is really not looking good, because it was 85 and now it's sitting at about 16. So you have lost about 80% if you actually bought at these levels. And this is again why you really, really should refrain from buying at these levels. You will see at the recent time there has been this 25% increase. That is, again, we can take a look at the 1 month chart. This 25% increase that actually prompts people to actually potentially start buying again. And this is what a lot of people do whenever they see a price spike. They're like, okay, this was 80% down, so maybe it's some time to start buying. And that can be a solid thing to do when you are trading the stock and you are looking to get rid of it at some point soon. But if you are looking to accumulate for the long run, you want to examine what the company is doing financially and not just by being blind, like not knowing what the company is doing in terms of money. Because cheap in the stock market can get more expensive, but typically cheap gets cheaper, because it doesn't really follow through the financials. And so we do want to be finding companies that do get cheaper, but their financials are stellar. So let's take a look at whether that's the case with Robinhood here. Their P ratio is actually going down, and again we have 2 years here. It's a recent IPO. And the price to free cash flow ratio also going down with the revenue of the company. Outstanding shares are at least also kind of going down. They're pointing to a company that's not diluting investors. That's a good thing. But the 5-year revenue growth here is increasing. So we are seeing a spike in growth for the company, yet a loss in net income and a loss in free cash flow, and a massive loss in net income as well. At some point it used to be positive, actually. That's surprising. But now it's a massive loss, 3.6 billion. That's heavy. And the gross profit margin is high, but the net income margin is very, very low. It's actually negative. So that's a bad thing to see. Company has a little bit of debt, doesn't look massive here, but we will examine it in detail. This is compared to the equity of the company. So compared to the equity of the company, it doesn't look massive, at least. But it's increasing. So all the returns of the company are negative because the company is not making money. But let's actually take a little bit of a closer look at the financial statements, because I want to see how their net income is actually produced here. And you will see that it used to be positive this year, and then it became really, really negative. And we can, of course, take a little bit of a closer look here and see what is going on. So the total operating cost and expenses used to be 800 million, and now it's 3.5 almost billion. So it's a massive increase in expenses and operating cost of the company. I'm assuming this may have to do with allowing for more stock-based compensation and things of that sort. Although they do spend a lot of in research and development expenses, that is bothering me a little bit. I'm not sure what kind of research expenses a company like Robinhood would have here. But they also spend a lot more in like their total expenses, a lot of which is, though, the research and development expenses, because the other expenses are not that much higher. Selling and marketing as well, and general and admin expenses, quite a lot of too. Okay, so the next thing, I want to take a look at their balance sheet here, see if they're accumulating more total equity here, which they are. And it's interesting because they haven't seemed to have increased their stock really. They haven't issued shares. And so I'm assuming they're getting quite some debt. That doesn't make sense otherwise because they are not cash positive. So they must have been getting some debt here, which we will examine when we take a look at the cash flow statement. It's the easy way to see that. And yeah, as I was expecting here, and frankly, I haven't looked at the cash flow statement before making the video. It's probably the only thing that I didn't look at, but I didn't, and I was kind of anticipating that based on the things that I've seen in the income statement, and I mentioned it earlier. So yeah, you will see that the stock-based compensation, which is added back to the cash flow statement, has been insane. Look at that; they have been paying their employees with stock pretty much. I don't know how much they would like that right now. And that is a dangerous thing to do, especially when the stock is down, because previous employees that you paid with stock that was at $80, they're now getting $20, and so they may really want to leave soon or get more stock, which means that at some point the company will have to issue shares in order to give them this extra stock, and that becomes a very, very dangerous thing for you, the investor. And now the net cash for investing activities is what you would kind of expect here, not much going on. But what I want to see is the cash from financing activities. And you will see the other financing activities, again, what I was expecting, 2.2, 5.1 billion. This is debt pretty much. So the company has been getting some debt, repaying a little bit, but for the most part increasing its debt, as you can see here. And the free cash flow is actually negative right now. And that's obviously the most dangerous thing, the fact that their net income and the free cash flow is negative. So we will take a little bit of a look now at the stock evaluation tool, see what we can get out of this. Again, we have data for pretty much 2 years. And the revenue growth of the company has been amazing, and it probably will keep increasing, although they do have quite some competition. I will allow for more growth here because I think they will achieve that. So I will go for 25, 27 and 30. I think it's achievable for the next 5 years for them, although it may be a little bit of a stretch. But it will get adjusted because of the other values, which are kind of looking horrible here. Because the net income margin, the only year that they were positive, it was 1%. And so with that 1% will bring the valuation massively down, because this discounted free cash flow model is based on profit that the company is making and converts to free cash flow. Otherwise, what are we examining really in terms of profit? There's nothing. And so we will have to have a little bit of net income margin in order to make profit. So here I would have to go like maybe 3, 5 and 7 and make a deep assumption about what they will be doing in the next few years, and pretty much hope that they will be net income positive. If that doesn't happen, then we are looking at much lower valuations even. So this model will not give you something that makes a lot of sense. And so the free cash flow margin here, you will see that again we have some outliers here, and then 26%. So I'm gonna go maybe 30, 40 and 50. And again, I'm being a little bit aggressive here, allowing for a little bit of potential growth for this company, because otherwise we're gonna be getting insanely low values. And I think that's probably the more precise way to do it. But I just wanted to give it a little bit of a leeway so that you can see what we're getting out of this, even a little bit aggressive here. So typically I want to be getting 13% for my annual return. And if I calculate here, you will see that we are looking at very, very low values here compared to the current price. And that is because the company is not making cash flow. And the only thing that we could be projecting here is just that the company will achieve higher margins. So let's just say that the company somehow achieves 10% and then 15% and 20%, and somehow they achieve something close to 26% and more for the next few years, so 30, 40 and 50. I think that still makes sense. And so if we calculate with these values now, we are still getting a value that is much lower than the current price. And so even though the company has been really battered down in terms of its stock price, and again, if you take a look at the stock analysis, you will see it here. It was 85 with a 1-year low of 10. I just can't see myself entering the company for the long run. I feel that there is much risk going on here, and I could be losing money. Now, again, if this somehow becomes another trend and people start piling money on the stock, you could definitely see it going higher, but it won't be because of the financials. And if that's the case, which will be the case, then I don't really see what I'm investing in. I'm investing in hype, and that's not how I invest. I want to be investing in companies that actually make money. because this is much less risky. If you invest in these kinds of companies, like companies that don't make money and they are trendy, 9 out of 10 will eventually go, not if not bust, very near, losing you a lot of money, really. So you could actually lose a lot of money from an investment that actually doesn't make money, really. But if you buy a company that does make money and it's down, then okay, you will wait for it, and it will eventually correct itself, because money loves money and they will eventually pile in on that. There's no doubt about it. But over here, I feel like we're investing early for something that hasn't happened yet. Plus, there's a lot of competition in this space, and not much proprietary. Not many proprietary things around. Like it's just a broker with an application. Many of those laying around. So hopefully this video gave you some ideas. I hope you enjoyed it. Please leave a like if you did, that really helps. And you may consider subscribing, because at some point I will be giving you access to this tool and you want to be around for when that happens. I will be informing you in about a couple of months or so. You will be allowed access. So thank you for watching this video, and hope you enjoyed. In the meantime, take a look at this one that I made earlier, and it talks about Tilray, a well-known company that is a little bit trendy these days. And thank you for watching this one again, and I'll see you soon. Bye bye.